Hello, my name is Lauren Goodwin, and I'm the Chief Market Strategist at New York Life Investments. Every few weeks, I hop on to record a US perspective on what's happening in the economic, market, and investment environment. And since the last time we spoke, there have been some major changes. On April 2nd, President Trump announced tariffs that approximated the worst case scenario for investors. Our colleagues at Candriam have done a fantastic job modeling what a soft or more moderate Trump scenario on trade might look like compared to a harder, more challenging trade environment, and these tariffs surpassed even the hard Trump scenario. So now as investors, we have several areas of uncertainty. The first is on trade itself, and here I don't have any additional insight, but we do know that President Trump treats tariffs as two things. For one, a negotiating position on areas like defense spending in Europe, national security with respect to China, immigration with respect to Mexico and Canada. The most challenging of these globally is likely to be with China, because the US and China are competing for major sections of the semiconductor supply chain. And so we anticipate that tariffs overall will remain much higher than they were just a few weeks ago, even as negotiations continue. Another area of uncertainty has to do with the US Federal Reserve. On April 16th, Fed Chair Jay Powell admitted, and we believe that this is correct, that tariff pressure is likely to put inflation upwards, growth downwards, and these are essentially pushing the Fed's two mandates in opposite directions. Now, it's our perspective, counter to what the market believes, that it will be very, very challenging for the Fed to cut interest rates when inflation is this high, and that has major implications for investors. Perhaps the most important is that we expect it will be more challenging for the Fed to cut interest rates absent a dire recession scenario than it will be for the European Central Bank. And more support for the European economy, though it may not be enough to cause a real reacceleration, it may still allow some opportunity for European equities to outperform. And so amid all this volatility, US investors, which are largely underweight ex-US equities, we're encouraging them to close those underweights to add exposure to ex-US equities. Now, one more area of uncertainty has to do with companies. Earnings season has begun in the US and globally, and we're hearing companies either pull back guidance, say that they can't provide guidance in a scenario like this, or provide two forms of guidance, scenario one, scenario two. And that's a very, very challenging environment for the market because it essentially says, in our view, that a strong recovery in equity valuations is unlikely. And so in our portfolios, we're focusing on rebalancing geographically, as I've identified. We're focusing on resilience, including areas of income generation in bonds, dividend-paying equities. And we're considering some of the more constructive elements of this global change. For example, even if the trade environment continues to be challenging, we feel confident that the semiconductor supply chain, the energy supply chain, and reglobalization trends generally create opportunities in energy and digital infrastructure, in defense in some parts of the world. These are parts of the market where we believe may still have some resilience despite volatility. So that's it for today. I'll come back soon to discuss more US views on the market. Good luck out there. Thank you for your attention.